Go. For this mock exercise, we're going to take a look at performance evaluation and compensation. And we're going to take a look at some of the tools that we're going to use to evaluate the company's performance or the management's performance. We're going to take a look at the company called Bernard Company. And we're going to take a look at 3 of those tools. The first one is residual income. The second one is ROI, and the third one is EVA. So let's take a look at the theory behind those evaluation tools. So the first one is called the ROI, and ROI is sometimes called the DuPont method of profit analysis. And the formula is simply operating income, that means income before tax, divided by average operating asset, which means that we're going to take a beginning and ending operating assets from 2 points in time. We're going to divide it by 2. Now remember, the general rule of ratio analysis, if we're doing a ratio that has an income statement component which describes a period of time activity versus a balance sheet item which is a point in time activity, if we're using that in our calculation, we always want to use an average for the balance sheet item. Now, operating assets for ROI normally means total assets minus total liabilities or shareholders' equity. But depending on the company, the definition of operating asset could mean many different things. So it's really important when we're establishing these performance measurements for management is we define what each one of these includes or excludes. So if you go into the business world, oftentimes if you're measuring ROI for divisions or company or management's performance, we have to define what's included and excluded from these 2 definitions. Now, ROI can be broken out into 2 components, as you can see from this formula. Profit margin. Profit margin is basically measuring the efficiency in which we're able to generate income from the sales, which means that we're looking for efficiencies in the way we manage our cost. The more sales we bring in and the less cost it takes us to bring it in is what profit margins measure. Turnover is again measuring the effectiveness of how much our assets generating revenues, generating sales. So that's what a turnover is, really the effectiveness of how we're utilizing the total asset to generate sales. So the formula is sales divided by operating asset. So that's called the ROI analysis. Now, in your lecture notes, there are positives and shortfalls of using ROI. And one of the biggest shortfall of ROI is the fact that when you're looking at a division that's already at a higher end of the ROI. So let's say a division A is already operating at 20% ROI. It's going to be difficult for that division to accept projects that are going to be, let's say, 15%. Although 15% return is probably way beyond the average of what the expected return is for that company. But in that particular case, Division A wouldn't accept that special project because it's going to drag down their 20% ROI to less than 20 by accepting a project that's going to generate 15%. Even though that 15% is above expectation, above the average required rate of return in the market. So that's one of the biggest shortfall or downfall for ROI. The second way to measure performance is perhaps using a different method called residual income. And residual income essentially allows us to address some of the shortcomings of the ROI. This formula says we're going to take the operating income, which is the same as the ROI formula, which is net income before tax, and we're going to subtract a charge of using that asset. So here, we're not calculating a percentage in the ROI, as in the ROI. We're going to calculate a dollar amount. And that dollar amount, the higher that is, the higher positive that number is, the higher the residual income. So we're going to take the operating income, we're going to subtract a charge using the required rate of return times the utilization of that operating asset to help us generate this operating income. Now, ROI measures operating income earned relative to the investment in average operating asset. Residual income measures operating income earned less the minimum required rate of return of utilizing that operating asset. So this one here allows us to look at the dollar amount and then looking at, of course, allows us to hopefully make a decision that's consistent with the overall corporate goal. So in my original example, when you have a Division A already making 20% ROI, if they have another investment opportunity that earns 15%, using RI as a way of measuring means that that manager is going to accept that special project added to their existing RI and still improve their overall RI. Now, a modification of RI is our third performance measurement called economic value add, or EVA. EVA is actually one specific type of RI calculation. And in this case, we're going to take a look at, instead of operating income, we're going to take a look at net operating profit after tax. So we know that tax is a reality. Tax is what is often paid to the tax agencies for making profits. So let's incorporate taxes into the operating profit. So that's what NOPAT stands for. It's net operating profit after tax. And we're going to charge, again, the same idea, we're going to charge a cost of using that asset, except we're going to take a look at total assets, subtract current liabilities, because we know that obligation is something that we need to pay. So we're going to adjust the total asset by current liabilities, and we're going to multiply it by the weighted average cost of capital. And weighted average cost of capital represents the after-tax cost of capital from a mixture of debt and equity source. So what we do look at is we look at the company's capital structure, how much debt, how much equity they have used to finance the overall resources of the company. We take a look at that and we incorporate the fact that that interest cost is tax deductible. So we always look at the cost of debt as after tax. But equity, the cost of using equity in the form of dividends, is usually paid after tax. So we do look at the sources of equity, irrespective of how the company has financed that particular investment. So it's actually not relevant. Here we're looking at the overall use of their capital. Now, the average, so the total asset, okay, again, the definition of total asset could be only capital employed. It could be many multiple different definitions. It could also mean we're going to take the R&D that we normally would expense from an accounting perspective to give us operating income. We might want to adjust for that. And again, we're going to look at perhaps the definition of how each of these components in EVA, particularly when evaluating management's performance. And again, leases is another example of those multiple adjustments. So let's take a look at this question. So this is a simple question, and this question is meant to kind of give us a good understanding of how the formula works. So the following selected data from this company's construction division last year. So we've got sales, variable costs, we've got traceable fixed costs, we've got invested capital, or what we call asset, current liabilities, required rate of return is 15, and we've got the marginal tax rate of 36, and we've got the weighted average cost of capital of 12%. The first part of the question asks us to calculate residual income. B asks us to calculate ROI, and then of course C asks us to calculate EVA. So let's take a look at that. So for the first part, residual income, going back to the formula, we've got operating income, stands for OI, subtract rate of return times average assets, operating assets, right? So operating income, okay, we weren't given that, so let's calculate. It's 2 million. Subtract the variable cost, subtract fixed cost, minus, what's the required rate of return? 15%, times the average invested capital is 3 million. And that gives us a positive of 150,000. Now I want to do EVA next, so I want to show you a comparison. So when we do EVA, we know that EVA is NOPAT, so net operating profit after tax. In this case, the net operating profit is the 2 million less the 1.2 million. Okay, that's 800,000 less 200,000 is 600,000 times 1 minus the tax rate. Okay, so let me write that down. That's the tax rate. Okay. Now, we're going to subtract the weighted average cost of capital, so that's WACC, times total asset less current liabilities. Okay, so that's the formula. So let's take a look at that. So minus. Now we're given the weighted average cost of capital, 12%. Now, we might have to calculate this. So I want to write a little note here is that you might need to know how to calculate weighted average cost of capital. So please make a note of that in your review. Now, 12% times what was the actual invested capital is 3 million less liabilities. Because we know that liabilities is an obligation that's known, and we're going to subtract it from the capital, the invested capital, to know exactly how much capital was utilized in the business. So this is 384 minus 336. Okay, so a little bit different than the RI, isn't it? And this one here really looks at it a little bit more, and you can see how this is the same, similar formula, but you can see that EVA is a much more realistic depiction of what we need to calculate, as opposed to the residual income, which is a much more simplified basis. Now let's do B, the ROI. ROI, we're going to take a look at operating income divided by average investment. And in this case, it would be 600,000. Okay, that's from here, right? These are 600,000 divided by 3 million. This gives us 20%. So let me just make a small adjustment. This one here is 600,000 operating income. Okay? Thank you.